Have you ever wondered how global events like financial crashes, pandemics, or geopolitical conflicts can either destroy fortunes or create new millionaires? What if understanding these crises could unlock the key to safeguarding and growing your wealth? Global crises like financial meltdowns, pandemics, wars, or natural disasters are like earthquakes that shake up economies, change industries, and have a big effect on people's wealth. Even though these crises cause a lot of confusion, they also create chances for smart investors who know how to handle rough times. History shows that how people handle global problems can affect whether they get richer or poorer in the long run. How global crises affect personal wealth right away. When there is a global crisis, the stock market and other assets like real estate, bonds, and stocks often drop sharply. When investors sell their stocks because they are afraid of the future, the value of their investments usually drops right away. For example, the global stock markets lost trillions of dollars in value during the 2008 financial crisis. This wiped out many people's retirement savings and personal income. In the same way, the COVID-19 pandemic in 2020 caused one of the fastest stock market crashes ever, with major averages falling over 30% in just a few weeks. Even though these things can be very bad, they also show how important it is to plan your investments for the long run. When markets go down, investors who sell quickly often lock in their losses. Investors who are patient and stick to their plans, on the other hand, tend to recover as markets stabilize and finally rise again. Changes in industries and the distribution of wealth caused by crises. During global crises, industries often change, with winners and losers. For instance, the COVID-19 pandemic sped up the uptake of digital technologies, which helped companies like Amazon, Zoom, and Netflix reach new heights while hurting traditional industries like travel, hospitality, and retail. This change shows how important it is to have a diverse range of investments. People can lower their risks during sector-specific downturns by spreading their investments across different businesses and asset classes. Investors who correctly predict these changes can also make money by putting their money into new possibilities: inflation, deflation, and changes in the value of the currency. During economic crises, prices often rise or fall, and currencies can become unstable. All of these things have a direct effect on people's wealth. As an example, inflation. When crises mess up supply lines or cause too much money to be printed, inflation can make things less affordable. Following the COVID-19 pandemic, problems in the supply chain and rising geopolitical issues made inflation skyrocket around the world in 2021 and 2022, making cash savings less valuable. Deflation. On the other hand, deflation can happen when there is a serious recession because demand falls. As we saw during the Great Depression, falling prices can make people less likely to spend and make economic downturns worse. Changes in currency. When there is a global crisis, currencies can lose value, especially in emerging countries. People who invest in foreign currencies need to be careful about how these changes affect their money. Many buyers look to gold, TIPS bonds, or cryptocurrencies like Bitcoin as a way to protect themselves from these risks. Some see these as a way to keep their money safe during uncertain times. The role of real estate during hard times. During crises, real estate often acts in different ways, based on the type of event. During financial crises, when demand for homes drops and credit becomes harder to get, property prices may drop sharply. For example, the 2008 financial crisis led US home prices to drop by a lot, which gave investors with lots of cash the chance to buy properties that were undervalued. However, during crises like pandemics, there may be more demand for certain types of real estate. Real estate investment trusts, REITs, are another way to spread out your property investments without actually owning any of the properties themselves. They offer a mix of growth and income possibilities. Behavioral economics is the study of how emotions affect money choices. When there is a global crisis, buyers have to show how strong their minds are. Behavioral economics says that people often make bad choices during crises because they are scared and uncertain, like selling things in a panic or saving cash. These actions can hurt a person's wealth a lot. Investors who do well know how important it is to control their emotions. Having a well-thought-out financial plan and resisting the desire to act on impulse when the market is volatile can help you avoid making mistakes that cost a lot of money. Dollar cost averaging is a good approach in which investors always put in the same amount of money, no matter how the market is doing. This method protects against the emotional effects of market changes and guarantees long-term wealth growth. Chances in a crisis, making money in the middle of chaos. While global problems take away wealth from some, they also make chances for others. As an example, assets that are undervalued. During market downturns, good assets are often sold for less than they're worth, Warren Buffett famously said. This quote shows how important it is to spend in the opposite direction of what everyone else is doing during crises. Important new trends. Crises often give rise to new businesses and economic trends. The 2008 financial crisis, for example, sped up the growth of fintech. Investors who spot these trends early and put money into them can make a lot of money. Why diversification and asset allocation are important. Diversification is an important part of investment, especially when the world is going through a crisis. Investors can lower their general risk by putting their money into different types of assets, like stocks, bonds, real estate, and commodities. Also, putting your assets in the right places based on your risk tolerance and time span can help you get through crises better. For example, younger investors with more time to spend may put more of their money into stocks, while older investors may prefer bonds and other lower-risk investments. During crises, it's also important to rebalance portfolios on a regular basis to make sure that asset mix stays in line with financial goals. What governments and central banks should do. What governments and central banks do during global disasters has a big effect on people's wealth. Policies like fiscal relief, monetary easing, and quantitative easing are meant to keep economies stable, but they can have different impacts on different people. Making yourself stronger for future crises. Global disasters seem to be happening more often, and with more force because of things like climate change, rising geopolitical tensions, and economies that depend on each other. In this unstable world, building grit is important for keeping and growing your wealth. Here are some strategies. Emergency funds. Having extra cash on hand to pay for sudden costs during emergencies means you won't have to sell investments at a loss as often. When you manage risk, you use tools like insurance, stop-loss orders, and hedging techniques to protect yourself from losses. What we can learn from past crises. Investors can learn a lot from looking at past financial problems. Inflation swaps and different types of energy were made clear by the oil crisis of the 1970s. The financial disaster of 2008 showed how dangerous speculative bubbles can be and how important it is to have cash on hand. By looking at these events, managers can come up with plans to deal with and avoid problems in the future. There will always be global disasters, but how they affect people's wealth depends a lot on how investors react. Even though these events mess up economies and markets, they also open up chances for people who stay disciplined and educated.